Welcome guys back to MMG. Let's talk about Powell and the congressional hearings. So I watched it so you guys don't have to. It wasn't that bad. Usually there's more grandstanding by the politicians and they ask horrible questions. So they, impress their constituents. But there was some gold nuggets or some good takeaways, I guess, from the hearings, and I'm just gonna go over them real quick. TA wise, I'm wearing my BTFD hat, means buy the fucking dip, and that's because I bought the dip on metals and metals ETFs. I went long yesterday. So, and it turned out pretty good. I mean, metals did pop, and I actually expect them to continue to pop, and I'm going to talk about that in rally because of the congressional hearings. Basically, Powell said something, he let something slip. And I don't think most of the market realized, but I did, and we're going to watch that. Now, I'm not going to add too much commentary to this. I don't want to make this a long video, alright? So let's just get into it. Let's start it.
Of 1.5%. We don't have that kind of room, and there are a couple of reasons for that. Just if you look at the longer-term interest rates, which are not directly affected much by our policy, they've just been declining for 40 years now, and that is because of inflation being lower and under control and less volatile, and also just the aging demographics means higher saving, means more savings relative to investment, and that puts downward pressure on interest rates. So I think the new normal now is lower interest rates, lower inflation, probably lower growth, and you're seeing that all over the world, not just in the United States. You're seeing it to a much greater extent in many parts of the world than we're seeing it here.
Yeah, it's what they're shooting for is pretty much what Japan has done. And they're actually hoping that is how this will all play out, which it will not because of the surmounting debt and the bubbles that have been blown in different asset classes, like a lot of them, most of them.
So, knowing that, that is one of the main reasons we have, really the basic reason why we are having this public review of our monetary policy framework to see if there are ways we can alter our strategies, our tools, and our communications in ways that would make us more effective in this world where we're too closer than we would like to zero when we kind of run out of options. So that's one thing. Fiscal policy will also be important, though. I mean, I think from the standpoint of monetary policy, we're looking hard at ways to make sure that we can use our tools even after rates go to zero. Ultimately, fiscal policy has been a key part.
All right, let's rewind. Did you catch it? All right, listen closely. I know he's talking quickly. That's because it's fast forward. I don't want to make this a long video. But try to catch what he let slip.
When we kind of run out of options. So that's one thing. Fiscal policy will also be important, though. I mean, I think from the standpoint of monetary policy, we're looking hard at ways to make sure that we can use our tools even after rates go to zero. Ultimately.
Did you hear it? One more time. So you could hear it from the horse's mouth.
Options. So that's one thing. Fiscal policy will also be important, though. I mean, I think from the standpoint of monetary policy, we're looking hard at ways to make sure that we can use our tools even after rates go to zero. Ultimately, fiscal policy has been a key part of the countercyclical reaction as well.
So he said it's important for them to have their tools and blah blah blah. What is their stupid tools? I mean, the only thing they could do is raise and lower interest rates and print money. That's the tools. I work on cars, it takes more than 3 wrenches. But he literally said after rates go to zero. So he accidentally admitted they're going to zero, guys. I've been saying this, and no one would believe this. If you said the Fed is going to go to zero on interest rates 6 months ago, people would have thought you're crazy because they were still talking about raising interest rates and letting all the debt run off their balance sheet. Right now, their balance sheet's increasing by $200 billion from the repo market. One more time. Can I slow this down? No.
Closer than we would like to zero when we kind of run out of options. So that's one thing. Fiscal policy will also change the world.
Let me rewind.
So knowing that, that is one of the main reasons we have, really the basic reason why we are having this public review of our monetary policy framework to see if there are ways we can alter our strategies, our tools, and our communications in ways that would make us more effective in this world where we're too closer than we would like to zero when we kind of run out of options. So that's one thing. Fiscal policy will also be important, though. I mean, I think from the standpoint of monetary policy, we're looking hard at ways to make sure that we can use our tools even after rates go to zero. Ultimately, fiscal policy has been...
So he literally admitted that normally during a recession, they would drop interest rates 5%. The fact that interest rates currently are below 2%, right? They can't drop at 5%. So they don't have all their so-called tools. And he's already admitting, well, we're going to drop it to 0. And then they're going to look at their tools, which is what? Money printing, because that'll be the only thing left. They can't have negative interest rates. I mean, I guess you can. There's a few European countries, but nobody... I mean, what's the long-term consequences of that? When you borrow money and you don't have to pay interest back. Whoever lent you the money pays you interest. That's backwards. That doesn't work. In a real economy, no one's going to do that. So it's insane. So what I'm saying is he just admitted that they're stuck. For one, the next recession, they're not going to be able to cut much rates because they're already near 0. And they're probably going to go to 0 before the next recession anyways. And he literally said, we're cutting to 0. He accidentally sort of let that slip. So one more time, because no one else, I don't think, caught this.
That's one thing. Fiscal policy will also be important, though. I mean, I think from the standpoint of monetary policy, we're looking hard at ways to make sure that we can use our tools even after rates go to 0. Ultimately,
even after rates go to 0. So he's talking about using his tools even after rates go to 0, which is money printing, because that's the only tools they will have left, besides raising rates back up. But he also said it's very important that fiscal policy happens, meaning the government needs to stop spending money. Or maybe he wants them to spend money. Depends how you look at it. Because he might just print money and then give it to the government, and government starts cutting people's checks. And that's when you get the helicopter money scenario.
Fiscal policy has been a key part of the countercyclical reaction as well, though.
And next question, the disruption in the repo market that took place in September. Anticipated, not anticipated? Do you anticipate keeping the expansion at the level it is until you're sure that won't happen again?
Well, so anticipated or not, it's a different world post-crisis, and really because of all the expansion in our balance sheet, and essentially what we've done now is we've now required financial institutions to have a lot more liquidity on their balance sheet so that the Fed doesn't have to run in and with our own liquidity. So that's I think, a big benefit to the financial system. But a lot of that liquidity is held in our reserves. We used to manage the interest rate by keeping reserves scarce, and we had a total of $20 billion. Right now we have in excess of $1.5 trillion in reserves, and so that means that we're trying to find that level as we allowed the balance sheet to shrink, where reserves would become scarce, and there was really no way to know. I think the data that we had suggested that we were...
Okay, what's he talking about? Well, he's talking about earlier in the year, this year, and last year, when they were allowing their balance sheet to shrink, the trillions, that's what caused the repo market. He's literally admitting to that when they started raising interest rates and letting the balance sheet run off, it caused illiquidity. So liquidity dried up on the interbanking lending rate for all the other banks. So essentially, they caused the repo market to dry up, and now they have to reliquify it. But as you can see, the day after day, they're just injecting hundreds of billions of dollars. And yeah, they pull some of it back out, put it back on their own balance sheet. But overall, the balance sheet is being monetized, meaning it's growing. So they are just making money out of thin air and putting it into the market. It's slowly, but it's happening. The last time they did this repo thing was in 2009, after everything blew up. So I'm thinking something big happened. They just don't want to, they don't want to make it public to cause a panic. They could always do that, guys, under security, right? And blah, blah, blah.
not close to that point until September. I think we're still very much looking at what happened in September, but I think we learned in September that we needed to make sure that reserves didn't go under that level that we were at in mid-September, which is a little bit shy of $1.5 trillion. So that's really what we're doing. It's technical. I think we have it under control. We're prepared to continue to learn and adjust as we do this, but it's a process. I would say it's one that doesn't really have any implications for the economy or for the general public, though.
Thank you.
To benefit. Do you have any insight on knowing where they are or if they're working together and will be able to meet that end of the year goal?
So we strongly support the mission of CRA, which is to assure credit availability in the areas that banks serve, particularly low and moderate income communities. We think it's a good time to modernize given technological developments and all kinds of other developments. We've been working very, very hard with the other two bank agencies to try to find common ground, and we're committed to making sure this reform actually puts us in a better place to serve the intended beneficiaries of CRA. We haven't quite gotten there yet.
San Francisco.
So she was asking him, how could you help the banks lend more money to more poor people, right? Which normally the private market wouldn't do that. Why would you lend money to people with poor credit who don't make much money? Because historically they tend to borrow a bunch of money and not be able to pay it back, and that causes hazard, risk, and banks aren't the bank's not going to lend you money if you're not credit worthy for a reason. And well, a good example of that was everyone with a pulse got a mortgage back in the early 2000s. What resulted from that? They took away Glass-Steagall and all those regulations, and I'm not in favor of regulations. But there are always short-term repercussions of when you take them away. And it's different with lending because there's predatory lending and whatnot. Because the banks will give them the loans, except they'll sell those loans to dumber banks or institutions, and they all speculate on it. And after a while, it just creates a giant moral hazard. Like because you get the mortgage-backed security crisis, and the entire system becomes infected with lower grade debt, junk debt. All right, next topic.
Recently held a conference entitled The Economics of Climate Change, and I believe this was the first ever conference by the Feds on climate change and the economy. Can you discuss how the Federal Reserve views the impact of climate change on our economy and monetary policy, and how the Fed's views have evolved over time?
So I guess I would say climate change is an important issue, but not principally for the Fed. It's really an issue that's assigned to lots of other government agencies, not so much to the Fed. Nonetheless, over time, it can affect us in some ways, which I'll mention. One just is that we require financial institutions and financial market utilities, the large utilities that are so fundamental to the financial system, we require them to be resilient against all kinds of things, including severe weather. There's a link between severe weather and climate change. So in a sense, we're already, to the extent severe weather is becoming more common, we're already incorporating that into our supervision. And we'll have to think ahead. We're doing a lot of research in this area to think ahead about sort of from a risk management perspective. Our perspective is not, we're not going to be the ones who decide society's response to. That's going to be elected legislatures, not us. In terms of monetary policy, it doesn't have any near-term implication for monetary policy. Over time, climate change could have effects, but it's not something that we'd be considering.
Okay. And only because of my time, my last question is,
Our society is actually in many ways
Did they really? Oh, man, climate change. So what's the Fed gonna do? Literally, what could they do? Print more money? Because of climate change, right? So I'm just gonna leave it at that. You guys know my thoughts and opinions. If you go through my Instagram, my social media. Oh, by the way, before I get too deep in this video, because some people can only listen this far into it before their heads overload with knowledge, go to my website, 15% off because of the holiday season, and it'll stay that way probably till the end of the year. 15% off, go on my website, watch that video if you're interested in gold, silver mining stocks, taking part of the largest wealth transfer in human history. And I bought the dip, right? So I'm expecting some more upside. And then in some later videos, we'll talk about if there will be a big correction and when, because I don't know when. But this looks like a great buying opportunity. A lot of the miners have fallen by a lot. and they're still near all-time lows, historic all-time lows. Good time to accumulate for the long term. And possibly good for a trade as well, a swing trade to the upside. Free indicators, my trading academy for beginners. You guys can see me trade, and I give you guys my opinions on the markets and some trades, right? And you guys could ask me anything in the private group. There's a few chat groups. There's like a newsroom where we keep you guys updated with the breaking news on mining stocks, on discoveries, and whatnot. And then me trading. You could ask me questions. I will start making some tutorial videos. I'll probably make those free, though. It depends. Let's continue.
Sweet spot. A, do you agree with that? B, what do we do policy-wise to stay there? And for those of us up here, how do we not screw it up? And then how do we actually bias it towards the positive? What would you do?
So, as I mentioned, 50-year low in unemployment, inflation low and under control, labor force participation ticking up, consumer confidence high. The outlook is good. I think households generally are focused on, according to the surveys, are focused on this healthy job market and wages going up. So it's actually a very...
So those pictures were of, goods, food you buy at the grocery store. If you're old enough, I mean, you know for a fact that the packaging of food, it's either bigger, the packaging has more air in it, or packaging, than the food, but the food inside shrinking, or it's literally the size of the food you're buying is shrinking slowly but surely, but you're paying the same price or more. It's called shrinkflation. When does shrinkflation happen? When the margins keep getting squeezed on companies, especially staples, right? Food. That never changes. It usually doesn't change. The margin, the cost, the profit margin for these companies, unless there's inflation. If inflation keeps running higher and higher, they have to at least give you less food or raise the prices. And that's what shrinkflation is. Shrinkflation is very visible and obvious. And they keep saying inflation's only 2%. But even with 2% inflation, your food's going to shrink over 5-year to 10-year span of time. Because 2% year over year compounds. So,
good place from that standpoint. That's not to say that every community has benefited. We know that that's not the case. How do we keep it there? So the key to this, given the risks that we see are slowing global growth and particularly weaker manufacturing, and that affects U.S. manufacturing. So the key to keeping this going and to it continuing are that we keep job creation at a solid level, that households retain their confidence, that wages keep moving up. That seems to be the engine that's driving the U.S. economy forward at this time. But I want to go longer term with an answer. I mean, the U.S. faces longer term issues that really need your attention around labor force participation and productivity. Those are the two things that we really, where we in labor force participation, we lag most other advanced economies. And that's something we can do something about. That really the Fed can't do much about it. It's more about fiscal policy. That's support attachment to the labor force.
So much of the policy.
So he was, Powell is better than most other Fed officials, the way he talks, because he's easier to understand. But he was correct about that. It's productivity and labor force participation. What is labor force participation? That's the U6 unemployment that I talk about. That is the amount of people who are at working age, right? From like 15 to 65 or 40, something like that. I'm not exactly sure. They're in their ripe years to work, but only like 60% are working, something like that. It's 90 million Americans out of 320 or something like that. So that's the problem. One is the U.S. isn't productive, and what he meant by that's the government's policies. What he means is regulations. He needs to lower regulations and taxes. And then the other thing is that's for productivity. And then the companies can start growing. New companies will grow. More entrepreneurship. That's when you start getting more people back into the employment back into the economy because businesses could expand because of less regulations and taxes, and more businesses are being created because of this. At the same time, more people are going to get jobs, and not just that, you have to take away the free stuff because then they're forced to go and be productive members of society, right? And that takes away both. So so when you don't give people freebies, right? Free stuff, welfare, then they have to join the labor force, and then they become productive. So there you go, pal. Productivity and labor force.
That we all engage in here could be pushing up labor force participation. We're right now, what, about 63.3?
That's right,
Which
yeah.
for some of our models of testimony we had as a committee a couple of years ago, we didn't think we'd get that far. But we
So 63% are working. That should be working. So only 63% of Americans. And most of them they're not full-time jobs. Probably only 40% of that 63%.
demonstrated that there is slack out there. Could you touch on what we could do in that demographic headwind that is where we are in the United States to also encourage that labor force participation? Incentives for someone that's older to stay in the labor force, getting millennial males to actually start to equal millennial females in the labor force.
I think
what would you do?
There's a
That's interesting. More millennial females are working than males. Now, why is that? Well, probably because of the current, if you're a male, like it's harder to get a job these days, because you're. I don't want to get into the SJW crap, but the other reason is there's no manufacturing jobs. There's no manufacturing jobs. You can only have so many paper pushers and secretaries, all right, and waitresses, and just service sector, retailers. Men don't want those jobs anyways. They want to make shit. They want to be out there working hard with their hands and with their minds. You need trades and skills, right? Machining, welding, construction, engineers, stuff like that. Building things.
range of policies, and they would appeal, I think, across the political spectrum. Some of them are about labor demand, some are about labor supply, and I think many of them would work. That's the great thing. And I think for young males, it's going to be addressing the opioid problem. It's going to be skills and training and internships. We had a great meeting with a bunch of experts on internship programs recently. I think you're seeing older people stay in the labor force more and more. Their participation is moving up. But you also see, I think there are lots of programs which are pulling people, for example, women who've been out of the labor force back in after their kids are grown up. You see that happening at places as well. So I think there are just so many things that can be done. And we lag just about every other wealthy country in the world in labor force participation for prime age workers. This is not where we should be, and I think there are things we can do about it.
In my last 26 seconds.
Wage gap. Women on the average make only 82 cents of the average man's dollar, much worse for women of color. But there are two sides to a family's budget.
Okay. It's BS. For one, women have to take off because they make babies. Two, if women make less money than men, then why wouldn't companies just hire all women? Because if they work, okay, so if you could pay them less, then you would just hire them all, right? And then they'll take all the jobs from the men. And it's not true, right? Because if it was true, then women would just find jobs and push all the men out. Well, that doesn't happen. Why is that? Well, it all comes down to productivity. It has nothing to do with anything else. And how many days you're on the job. Men tend to be workaholics more often. I'm not saying there's exceptions, whatever. I'm just saying. Women like to be around the kids and raising families. And it's probably healthier for the family as well. And then the male tends to be out there hunting, right? And bringing back the food, bringing home the bacon. Because that's what we've been doing for thousands of years.
The income that comes in and the expenses they pay out. And new research is finding that in addition to the wage gap, there is rising inequality on how quickly prices are rising for families struggling the most in the economy. This concept known as inflation inequality means the kinds of products disproportionately consumed by richer households, think organic produce and name brand drugs, rose in price at a slower rate than the kinds of products consumed by low and moderate income households. And just released research by Columbia University begins to quantify these impacts by updating poverty rates for an adjusted inflation index that accounts for inflation inequality. And the article goes on to suggest that an appropriate course of action would be to peg the federal poverty threshold to a higher rate of inflation, given how many more people would be considered in poverty when looking at the expense size of the ledger.
So that's funny, because that's proof that there's inflation. Of course they know there's inflation. But what she's talking about is that poor people are paying more for inflation than the rich. Well, no shit. Well, the rich are not affected by inflation nearly as much as the poor. Because the poor's, their percentage of income, most of it goes towards rent and food. And that's proof that inflation's higher than they say, right? Because if inflation keeps rising, who gets affected more? Well, the poor, because food goes up and so does rent. For the rich, they have assets, and they could, like, the percentage of their money that goes towards food is very small. Basically, when you live paycheck to paycheck, you really feel inflation. Inflation is hidden taxation on the poor and the middle class. The rich are fine because they for one, they're smart. Second, they have assets, they have revenue streams, and usually they're invested in the markets. And the markets could go and have a melt up and go higher and higher when inflation keeps running higher and higher. Another reason why we have inflation is because a lot of it goes into the stock market, eventually makes it out to Main Street, and then every Thanksgiving you could keep track of inflation by looking at how much you spent on the same amount of Thanksgiving food every year. And there's an index out there for that. Look it up, the Thanksgiving Inflation Index.
Just ask you whether or not any of this enters into any of your decision making, whether you have any research on this or any comment on this.
It's an interesting, so I did see that research.
It's interesting.
Which showed that so different groups of people buy different baskets of goods, and in principle, inflation can be higher or lower. This was a piece of research that showed that the basket of goods that are bought by people at the lower end of the income spectrum has experienced higher inflation over time. So, and that, the implication of that would be that their real incomes are even lower than we think. So I'd like to see a lot more research on that. That's an interesting recent paper that's getting a lot of attention right now. There's no definitive answer. There's a series that I guess the government currently conducts for consumer price inflation that looks at a basic basket of goods that finds a much smaller difference. Nonetheless, it's an important issue that needs further research.
Is that something that you would be doing, or you think somebody else would be doing that research?
Well, our researchers would do it, but you would tend to see, the agency, whoever does CPI, is it the Bureau of Economic Analysis, I guess, does CPI, and the economy's ability to grow as consisting of two things. One is how fast is the labor force growing, and secondly is how much is output per hour growing. That's what growth consists of, really just those two things.
Yeah, the CPI, remember? He literally just said that it's a government agency that does it, not them. Interesting, because they're private. There are some private companies that also do it out there, and their numbers are always higher. So what's the incentive for the government not to account inflation as high as it really is? Well, a lot of entitlements have to get adjusted for inflation. All right.
United States, the trend growth of our labor force has been very slow. It was 2.5% in the 1960s. Now it's about 0.5%, and about half of that is immigration. So immigration is a key input into our longer-term growth rate. And I would say if you look to population growth as a way to support higher growth for the United States, then immigration would need to be in your thinking. But again,
it's funny. People aren't having as many kids as they used to because they can't afford to. And not just that. The legal system gets involved with kids, and then the male is scared to have kids, right? Because they don't want to be a slave, and women are pretty different from what they used to be back in the day because of modern media. So it's a risk to have kids, and that's why and not just that, it's extremely expensive. A lot of 30-year, grown men, millennials, are still living with their parents. So that's why the population isn't growing. Yes, and you know what? That was true for most of. It's been true. Population needs to grow for the economy to grow. But again, there's no manufacturing jobs, and that's just that. There's automation now. There's robots. There's way more robots and automation than people really like to believe because they don't see it on a daily basis. But all your cars that you drive around with, most of it was built by robots, not by humans. A lot of the warehouse, all the goods shipped to your house from Amazon, especially, and FedEx and all that. There's huge assembly belt lines and robots moving everything around. And this is going to continue. Or everything's going to get automized. Automation's going to take over. And it's not going to be just industrial jobs and labor jobs. It's actually going to be more so service sector jobs like paper shuffling and cubicles. You're not going to, you could have software do what 1,000 people used to do, right? A lot of jobs right now are going to get replaced very soon by much smarter computers and programs and algorithms. So, do you really need more people? Also, with farming, there's literally robot farming machines now. So, do you need more consumers? Yes, but at the same time, if these people aren't going to be consumers, if your population's growing but no one's working, they're not consumers, all right? If anything, they're going to be a drag on the economy because they're going to get the freebies, right, to live.
And something we don't comment too much on.
Thank you. I yield back.
And I think you've addressed those, and also on immigration. Now, that could help us increase our labor pool. But I was thinking about the status of across the country.
Yeah, cheap labor pool. You have to understand, a lot of the corporations, they do like immigration. That's why they sell the U.S. out. And it's for cheap labor. But we don't need it anymore. There's automation. There's outsourcing across the seas and whatnot. That's why the middle class is just shrinking, like at an ever increasing. Like, there's probably not going to be a middle class, probably within 10 years, especially if the markets fall and we finally get the reset. There just won't be. They'll just disappear very quickly.
Now we've got over 30 states that put in minimum wage laws from $13 to $16. And there's something business is affected with everywhere. How do you see that's going to address the situation?
And then what happens? So they raise the minimum wage, then they fire a bunch of people, and then replace them with robots, like McDonald's and their kiosks, right? That's what happened. And you have to understand, a lot of the big companies, they lobby the politicians to actually come out with higher minimum wage laws to put out small businesses so they could keep their monopolies. These monopolies will always take a financial hit short term, but the long-term picture, they're always looking at the long-term picture. That's price gouging in a way as well.
On the mismatch between labor scarcity and yet this very low wage growth that we see, and how's that tie into inflation?
Well, we don't take a position on minimum wage. It's really an issue you have to balance. There are two things to balance. And if I were you, I'd look at a broad range of research. Research comes to different perspectives, but in essentially all the research you see, when the minimum wage is raised a significant amount, you'll see some job loss and you'll see some wage gains. And I would look at a range of that research and I would try to think what the right policy is. That's how I would do it. In terms of inflation, it doesn't really play much into it. First of all, our mandate is price inflation, not...
Of course it doesn't play into inflation, because no one's been getting wage increases that has been outstripping or outbeating inflation.
Wage inflation, we don't see wages moving up in any kind of way that suggests that they would put unwelcome upward pressure on prices. So I don't really think it is an important part of the inflation discussion right now.
And trying to trend
A wide range of wage and compensation measures, and what they tend to show is if you go back 5 years, wages and compensation were going up about 2%. That has gradually moved up to about 3%. And so that's really the trend has been upward. And that's consistent with the thought that a tighter labor market, lower unemployment, and surveys that suggest the labor market is tight. It is consistent with that. We've seen wages moving up. We look at I could tell you the principal ones we look at, but I think that's true across all major measures of wages over the last, let's say, 5-6 years.
Why do you think they slowed so dramatically the last 2 years?
I think It's hard to say. I think average hourly earnings is an important one, which peaked at 3.4% earlier this year or at the end of last year, and has been sort of trickling down. It's right at 3% now, so it's a fairly modest one. I'm not at all sure why that is. It may be compositional effects. Some argue that as older workers retire, younger workers come in and they have lower. But in any case, it's consistent with this idea that we're not seeing excessive tightness in the labor market that's generating outsized wage gains. We're seeing kind of nice wage gains given inflation.
Okay. Wages aren't gaining because there isn't demand for more skilled workers. Because the economy's not really growing. That's why. Maybe in certain sectors there are some shortages because a lot of kids these days can't work with their hands, like for skilled trades, whatnot. But employers don't have to pay anyone more money because there's the pool of unemployed or underemployed. Underemployed means you have a shitty job, but you got a college degree or you have skill sets where you could have a much better, higher paying, more skilled job. But the problem is there aren't enough jobs out there for these people. So companies could afford to pay them less and people will take the job for less money because it's better than not having a job or having a part-time, service sector job.
And productivity, but nothing that's at all out of line with that.
Thank you.
Debt held by the public expected to reach 95% of gross domestic product within the next 10 years. And yet we're also paying interest on that debt at an all-time historic low with a 30-year borrowing cost of just 2.4%. What's the reason for this, I guess some would say, fortunate fiscal reprieve at a time when Congress as an institution has shown really no sign of fiscal discipline at all? So where does it come from?
Well, it really is a long-term trend. For example, if you were to look at a graph of what the 10-year Treasury yielded, if you went back 40 years, what you would see is a ski slope down, and it's all the way down to today. This is a long-term trend. By the way, it's true all around the globe. Now, why is that happening? I think it's, first of all, it's inflation getting under control, becoming less volatile, and ultimately continuing to decline to the point where...
No. That's happening because of central banks and manipulating the markets. That's why for 3 decades we've had a bull market in bonds and yields have been dropping like endlessly. Someday it's gonna break, and the yields are gonna have to go up. The free market's gonna scream, "Listen, I'm not holding government. I'm not holding corporate. I'm not holding any debt unless you give me a really high interest rate and to hold it, to buy it, because it's too risky." And it's gonna come. The day is gonna come when people and everyone is gonna be defaulting left and right. All right.
The risk of lower inflation is actually greater than the risk of higher inflation at the moment. That's part of it. It's also just aging demographics. So as people get into their later years, they save more. That creates more savings and per dollar of investment, and that tends to drive interest rates down. And I don't know that trend shows no signs of reversing or anything like that. So that's really what's going on with these longer rates.
Some have suggested that because we in the United States, that the United States government borrows in its own currency, this level of spending isn't a problem because the Fed can just monetize the debt and keep doing so more or less indefinitely. Well, what's your reaction to that talk? Are the risks inherent in it?
Yes. No. As I mentioned in my testimony, the fact that interest rates are lower does mean that we will pay less in interest. It does not mean that we can ignore deficits at all. We're going to have to get on a sustainable path. What does that mean? So the debt is growing faster than the economy. It's as simple as that in nominal terms. And that.
So the Congress guy asked him, "What do you really think of MMT, modern monetary theory?" And Powell's pretty much answering, but without saying that that's what they're talking about. And what he's saying is, no, this is all unsustainable. See, I do like him. He does speak the truth at the best he can. And, yeah, I mean, it's completely unsustainable. Fiscally, the government has to, cut jobs and stop spending money. If they don't, it's all going to blow up. It's that simple. And no, they can't just forever print, right? I think they could do it though for quite some time, that's where they're really miscalculating. But even they know that this is all unsustainable.
is by definition unsustainable. Ultimately, you will have to get it to where the debt is not growing faster than the economy. And it's growing faster in the United States by a pretty significant margin. So even with lower rates and even with decent growth, there's still going to be a need to reduce these deficits. And I would say, by the way, that's a need over time. We're not in the business of advising you when to do that or how to do it, but it is inevitable that over time we will have to do it. And frankly, if we don't do it, what happens is our children will wind up spending their tax dollars more on interest than the things they really need, like education, security, health.
In the past, you've mentioned uncertainties in the area of international trade.
It's all right. The boomers, we got to take care of them first. I mean, literally a few nights ago, I was talking to a boomer, and he literally hit every key note. Like, he said, "How dare you?" And then I was like, "Your generation raised our generation." And he's like, "It's not my fault." He's like, "Your generation's faces are in your phones all the time." I'm like, that's not what I'm talking about. I'm talking about that you sold your kid's future. So you could have pensions and retirement and that speedboat. He's like, "Well, you don't work hard as us." I'm like, what are you talking about? We don't even have jobs anymore. Or, oh, God. And then I brought up the Brady Bunch. And then, eventually he knew. The one thing I like about the boomers is I could actually talk to them, and they're actually smart enough to know what I'm talking about. And deep down, they have such guilt because they know. And then they all say, "Well, I can't do anything all on my own." And I'm just like, oh, God. All right. Anyways, I just want to throw that in there. How dare you?
As imposing something of an economic headwind for us. What?
Regard to the national debt. Could you elaborate on that and how it should be addressed, particularly as it relates to expanding or at least not contracting the economy?
So I think it's a longer-term issue that I imagine we all realize will have to be addressed over time. It's just the case that now that the debt is growing faster than the economy, than the nominal GDP, and ultimately in the long run, that's not a sustainable place to be. Now, how to fix that? It's easy to say that, and how you do that and when you do that is an issue that is up to you and not to us. But I would be remiss in not pointing out that the consequences of not addressing it are just that we'll be spending more and more, our kids really and grandkids, they'll be spending their tax dollars servicing debt.
He said it real nicely. The longer you guys wait and don't cut your spending, you're selling your kids, your grandkids, and your great-grandkids' futures away. And they know that. They all do. And they just do it anyways because they're all psychopaths. Literally. That's why, and telling a politician you have to stop spending, none of them are going to do that. They won't get reelected. So the entire system's flawed, guys. It's flawed. The entire system is built to become a parasite or a cancer that just keeps growing and growing until it kills the host. And that's what's happening here.
Rather than on the things they really need, as I mentioned earlier, education, healthcare, security, all the things that we need, that they'll be spending more and more of their money on tax. But you don't need to balance the budget or pay down the debt or anything like that. You just need to get the economy growing faster than the debt. And that should be, I think, the goal. And by the way, the successful programs for countries to get back on a sustainable...
And that's when the Keynesian should realize that his entire economic models are flawed. He literally just said, let's rewind for a second.
They'll be spending more and more of their money on tax. But you don't need to balance the budget or pay down the debt or anything like that. You just need to get the economy growing faster than the debt.
You don't have to balance the budget. You don't have to even, get your debt down. You just need to get the economy growing faster than the deficit's growing and all the debt you're taking on. That's how a Keynesian thinks. That makes no sense. Because the more debt you have, the more interest you pay on the debt, and this kills the economy. Because that capital, instead of going back into businesses for growing and hiring and whatnot and innovating, that capital goes to pay the interest on debt that has already been accumulated. So therefore the economy eats itself. The debt eats the economy. And that's what these Keynesians who print money, by the way, printing money is creating debt, do not understand. Or if they do, that's even worse because then they're really evil. Or they're just trying to keep the music playing and they don't want the music to stop while they're in charge, and then they just, hand it off to the next guy, to the next sucker. And that's what's happening with corporations and CEOs, right? That's why they do corporate buybacks. We'll get that stock share going up, and I'll be done in a year. Then I'll sell my stock shares and I'll leave. And the next CEO will have to deal with the deteriorating balance sheet and all the malinvestment into their own stock that could, crash at any given moment.
And that should be, I think, the goal. And by the way, the successful programs for countries to get back on a sustainable path tend to take place over a long period of time and be relatively gradual. And I would be looking at something that would work over time, but really would not be giving you a lot of advice on how to do it.
With my final 30 seconds, do you anticipate maintaining the current Fed rate through the next year?
No, I wouldn't say that at all. What I've said here, and I'll go right to the actual language, is that we see the current stance of monetary policy as likely to remain appropriate as long as incoming information about the economy remains broadly consistent with our outlook of moderate growth, a strong labor market, and inflation near our symmetric 2% objective. So that's a very data-dependent statement. We do think monetary policy is in a good place, but we're going to be watching very carefully incoming data. And if
Yesterday at the Economic Club in New York, the president continued his criticism.
If that wasn't proof that everything is like fine-combed and looked through and purposely written in a way so the market doesn't freak out or it's doesn't become volatile after an FOMC meeting, I don't know what it is. That's why I actually did listen to this, because he wasn't reading off a script. He was actually talking. That's why a few times he actually said the truth, right?
Of the Fed, saying it had put the U.S. at a competitive disadvantage, and he also floated the idea of negative interest rates. Do you take comments from public officials into account when implementing monetary policy? And is there any precedent in U.S. history for this kind of criticism or praise from an American president?
So we look at.
So if you didn't watch the last video, you need to go watch that. I did the same thing with Trump, right? And Trump is just bashing the Fed, and he wants negative interest rates, and that's what they're talking about here. So watch that last video. That was also good.
Exclusively at the data, at the research, and at the performance of the U.S. economy. Those are the things we have a very careful, thoughtful process that's been developed over decades, over a century, really, and that's how we try to set interest rates. We don't consider political factors and things like that in what we do.
Thank you. I have a friend in Switzerland who went to borrow $10 million and got a negative interest rate, negative 0.3%. So they're paying him $30,000 a year to borrow $10 million. Do you see any prospect for negative interest rates in the U.S. economy?
I'm not going to lie. That sounds great. If you could go and borrow a ton of money, and you don't have to pay interest on it, they pay you, the bank pays you interest. That sounds great. It really does. That's why Trump was like so excited about it himself. He's like, that sounds great, guys. Let's do it. I mean, it is great for the short term. Long term, no one's ever been there. No one's ever done it. I personally, if I'll go take out a loan. I don't care. But I'll invest it in like something. You have to be careful though. I mean, you invest it in metals, silver, gold, and maybe some property that will give you a revenue stream, like an apartment complex or something. Another thing, this chick is definitely a millennial, and that the boomers, they're right about a lot of things. Constantly in her phone that entire time. It's gonna give you a hunchback. What are you staring at? Probably nothing important. It's really annoying. Although I do it too. But I run an empire off my phone. I guarantee you she's like on a field trip. Let's get back to it.
Well, negative interest rates would certainly not be appropriate in the current environment. Our economy is in a strong position. We have growth. We have a strong consumer sector. We have inflation that's a bit below target. So the very, very low and even negative rates that we see around the world would not be appropriate for our economy. Those you tend to see negative rates in the larger economies at times when growth is quite low and inflation is quite low. That's just not the case here. It's different for some of the smaller European countries. It's really about keeping their currency from appreciation, which is the case with a number of those countries.
Yeah. From December 15th through December 2018, there's slow, consistent increases in rates, and we've turned that around with recent cuts this year. Is there enough room to cut rates further if we get another slowdown or recession? Have we given up monetary policy as a tool at the moment for dealing with that?
Well, typical post-World War II recession has involved rate cuts of close to 5%. The current federal funds rate is in the mid-150s, so we're well short of that, 1.5%. So I think it's a fact, not just in the United States, but around the world, that central banks are going to have less room to cut in this new normal of lower rates and low inflation. So that's why we are conducting this external review of monetary policy at the Fed. We're looking for ways to make sure that we have the tools to do what we're assigned to do by you, which is achieve maximum employment and stable prices even in downturns. And that's what we're going to be doing. I will say also, though, that fiscal policy is often part of the answer, often a big part of the answer, often a big part of the answer when there's a severe downturn. We would certainly look for it.
Thank you again by bringing up the challenge that the public debt faces all of us here. You know, I was raised to believe that money supply and growth were causally related, that if our money supply grew more quickly than our economic output, that inflation was the inevitable result. But we're less than 2% this year. You have muted expectations. Is there no longer a connection between money supply growth and inflation?
Yeah,
Should I pay any attention to modern monetary theories, for example?
Well, so the connection between monetary aggregates and inflation, that's something we all learned in Econ 101. I did. It was important. It was generally thought to be, and empirically, it was a good relationship. I think about 40 years ago, as the financial system developed all kinds of alternative forms of money, the relationship between monetary aggregates and growth has just gone away. And so we of course look at those aggregates, but they no longer are a driving part of the theory. It's really the price of money as opposed to the quantity that we look at, which is interest rates.
I'm out of
Which is incredibly stupid. Of course the quantity matters. And talked about that plenty of times. If anything, I'm just looking at the people in the background, and I feel like they're just there to act. Like they doodle on their pens. I don't know. I always like looking at the people in the background, their facial expression. Some idea.
But thank you very much. Mr. General, you'll
Senator Cotton.
On robustness of how U.S. banks broadly are analyzing that risk. And basically what I'm asking is, do we need to start thinking through whether or not we need to either self-impose or at some point impose some sort of stress test to look at the assets that banks are holding and whether they're not, whether they don't have some concentration of risk if they're not thinking through that appropriately?
What we're doing now is we are trying to make sure that financial institutions that are in regions that may be subject to severe weather have plans to have redundant systems and be able to be resilient to that. That's the main thing we're doing. I think, so the Bank of England, it sounds like you're aware, is doing a stress test based on climate scenarios, but it's not, it's a stress test that's meant to be purely informative. It wouldn't.
Oh, God. All right, so their stress tests, none of them are actually a test for the banks in a case of a scenario of inflation. Nobody is expecting inflation. Nobody. Like, nobody. Everyone, even during this conference, they said it so many times. They're like, well, we know there's not going to be inflation. We're not expecting inflation. And even Powell seems to believe it. And nobody's expecting inflation. Nobody on the news. Nobody. That's why it's probably going to happen. No, I mean, it's going to happen because once the debt all comes due, they're going to be forced to step in and do something extreme like they did in 2009. And because they actually believe that there won't be inflation, they're going to print, and they're going to print more than even they believe they think or should. And even if they don't do that, then we would get a Great Depression. I don't care. Metals go up either way. I would rather have a depression than an inflationary depression, right? So, there you go.
Do what our CCAR stress tests do and potentially limit distributions and that kind of thing. That's an interesting idea. We'll be monitoring it. And I think we're going to benefit from some of the activity around the world that we're seeing with other central banks. We'll try to learn from what they're doing.
Yeah, we're obviously already seeing some places where it's harder to turn over a house in flood-prone areas. And if you had a concentration of mortgages that you were holding in areas like that, obviously that could pose a real financial risk. Do you think that GDP data adequately gives us enough of a picture about who is benefiting from the economy? And I guess
so I have real concerns that going into 2020 that we may see a slowdown in investments as those allocating capital look at the political scene and look at some of the economic proposals being put forth by Democratic candidates.
Oh, hold on. You guys can see that. It's funny.
GDP data adequately gives us enough of a picture about who is benefiting from the economy. And I guess
so I have real concerns that going into 2020 that we may see a slowdown in investments as those allocating capital look at the political scene and look at some of the economic proposals being put forth by Democratic candidates for president. And I have concerns that may cause people to tap the brakes in terms of deploying capital until at least after the election and finding out whether these policies.
So Mr. Cruz here is right. Once the market starts pricing in the fact that Trump might not win, the market's going to start falling. The more the market falls, it becomes a self-fulfilling prophecy. So the more the market falls, the more people worry that Trump's not going to win. And then the more that people worry about Trump not winning, the more the market falls. And then it turns into a death spiral. And that's what he brought
might
up.
Possibly be implemented. In your judgment, what would the likely economic impact be of the federal government implementing a massive tax increase?
Senator, I'm pretty reluctant to be pulled into the 2020 election, if you will forgive
And I
me.
certainly don't expect you to comment on the election, but you can't comment on the economy, and if a massive tax increase is good or bad for the economy.
That's indirectly, as you started your question, it's about proposals of candidates, and I just, honestly don't want to get into that business if you'll forgive me.
Well, let me ask you, a number of candidates are proposing a wealth tax, not just on income, but on wealth. Do you have any views on the economic behavior that would likely follow from a wealth tax scaling as high as 8% annually?
It is really not our role to score or evaluate campaign proposals, and that's what the CBO does. That's what lots of other people do. We really try to stay out of that business.
All right, well, let's try a different thing. Former Chairman Ben Bernanke in 2014 called the shale revolution, quote, one of the most beneficial economic developments in the country. Do you share that assessment? And conversely, do you have concerns about the impact on the economy if the federal government were to ban fracking and shut down the shale revolution?
I would certainly agree. I think that the energy independence of the United States is something that people have been talking about for 50 years, and I never thought it would happen, and here it is. It's in the nature of a miracle, it seems to me. So it's a great thing, I would say. It's not to say there aren't issues to manage, environmental issues, all kinds of other issues, but I think it's been a great thing for the country.
And would it be harmful to end it economically?
I wouldn't be I think to shut down the shale industry, that would probably not be a good thing for the economy.
Thank you.
Thank you very much, Mr. Chairman.
All right, there you go. So if you guys like this, please smash some likes. Leave anything in the comment section. I will reply. And share my videos. It's literally the only way my channel is going to grow. I'm starting to lose people at this point. I'm definitely on the radar. So it is what it is. I'll stick around. But, after a while, if my channel doesn't grow and there's no point of me doing this, because if you're not growing, then you're wasting your time. All right. So share my videos. It means a lot. And go to my website. 15% off. Won't last forever. Till next time.